So when we started our class today at marketscholars.com, a lot of the students were talking in the chat window about, is this the day? Is this the day that David thinks it's going to be bullish? So that's the question. That's the question of the day. Is today the day? Were we bullish enough today to finally get going to the upside? And if it is, what do we need to see for confirmation? If it's not, why not? So we're going to break all that down in today's video. I'm going to tell you what I think. I'm going to tell you whether or not I have changed. I'll leave the emojis on the tweet and everything for mystery purposes to make you watch the video. But I'll tell you what I think and what I expect the market will do, and by the end of this week, and then what from there on into the beginning of the next quarter. So we'll break down some of the major moves in different asset classes that may be driving some of this risk appetite here lately, and how that might drive the long-term potential for this risk appetite. And then from a sector rotation standpoint, from all the major global markets, what are they telling us right now? And then we'll take a look at our trade idea of a stock that, if we do turn to the upside, how do we trade that, just in case, right? Whether it is or isn't, if this stock is showing some really good bullish patterns, regardless of the market. So we'll talk about how to trade that going forward. So let's go ahead and get started. Today is Wednesday, March the 29th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the page, including the Market Outlook live video here. Come down to the bottom, click on that heart. Again, above 100. So again, thank you very much for helping us clear that big hurdle for us. We really appreciate that. To click that heart, it takes you to this tab. Hit that like button. You can also hit the retweet button as well, right? Click this thumbs up icon, takes us to this tab. Hit that like button. We really appreciate those who do that. It helps us get our content out to all of our followers on those platforms because of how their algorithms work. That's why we always ask for it. So thank you those who like us day in and day out, and those who don't, you can do it right now with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. So we got our bear tag today. We came close a couple days ago, but we did officially get it today. Not even close, right? We actually opened well above the line and then rallied and closed near the highs of the day. So good opportunity there. The near-term line still is rallying further than the momentum line set it up for. So that's still a little bit of an issue. We are 1.25%. If we can follow through in the next day or two, I did a breakdown for our market scholars today in class, and we looked at all the other bear tags, and the ones that didn't fail or turn into a weak fake out move, we ended up getting above the 2.5% mark within a day or two after the bear tag. This is a pretty good 1.25 is one of the bigger gaps above the moving average that we've had. So this is a really good close. That again, the fact that we had a gap that we haven't filled in, that appears to be a common gap, though there is potential that can be a runaway gap there. And then the fact that the near-term line, again, going further than what the momentum line had carried it to, opens up the weak areas of weakness there. So you have the intermediate line rising, still below market sentiment. And so we've seen this play out before over here, where you got the bear tag, and we didn't get above that 2.5% mark because we couldn't follow through with some good strong moves afterwards. The near-term line made it further than the momentum line wanted it to, and we ended up failing. We took a couple weeks, but eventually failed pretty hard there in June, and then we fell down to lower lows and just basically maintained the intermediate trend. That's the potential for what's happening here. Now, by the time we got the bear tag, the first bear tag, the intermediate line was, market sentiment was a lot lower, and the intermediate line was still in bearish territory. The intermediate line is a lot higher now, so it might not take a week and a half. If it's going to fail, it might not take a week and a half. It might, end up failing by the end of this week. So that's how the S&P is looking. Let's take a look at the NASDAQ, which has been so bullish. Dark green shading the green line, still kind of stuck below this really important level here that it can't quite get above. But still, I mean, that's dark green shading the green line. Can't argue with that. And the momentum line did get high here. So that is a good sign for the near-term line, which is lower than where the S&Ps is. But there is an opportunity. We're coming off of a bullish near-term low, so we can set up. I mean, this is setting us up for a good breakout move to get above. I mean, these again, all these Fibonacci levels are very important. The 38% retracement of the correction, the 38% retracement that we had broken below of the post-COVID rally, the 23% retracement that we had broken below of the post-2009 rally, so a big long-term move there, that we'd be back above that line. Very, very important. And then the 78% retracement of this one, that we'd be finally changing the trend, right, from bearish to bullish. Very, very important levels. 13,000 plus or minus whatever to get above those lines would be very, very bullish. Like, it would be changing dramatically the narrative around what's been going on for the last so many months, at least in the NASDAQ. Remember, that's been the most bullish. On the other hand, the Russell is nowhere near those levels, right? The 38%, the 23%, the 38% correction, the 78%. All those lines are way up here. Where the NASDAQ is sitting right at that level, the Russell's way down below the 38% of this intermediate decline, below the 23% of the of this correction decline, below the 38% retracement, way below, barely hit the 50% of the post-COVID rally, and then way below the 23% retracement line of the post-2009 rally. So nowhere near, and we're nowhere near the moving average. And the momentum line, the near-term line is worse here. It actually did get above 90, and the momentum line didn't even get above 70. So you have a very big disparity there that's setting us up for a failure here at these highs. It would, right? Now, granted, we break above that 38%. Now we got some opportunity. We can hopefully follow the trend, that the trail that the Nasdaq 100 is blazing ahead of everybody else. Here's the industrials, bear tag, just like on the S&P 500. Strong near-term line, just like the Russell. Weak momentum line that's in at the lower half of the chart, like everything else. So again, we're missing big divergence here. That typically means and we're barely above the moving average at that. That typically means we're going to fail. Now again, the past bear tags that turn into good bullish runs on this trend that we've been on. We get above the 2.5% mark on the S&P in a day or two. So we will know by the end of this week if we're going to be bullish, if we're going to really break out, especially considering that we have the PCE being released Friday morning. So we're going to really know how bullish this signal is. As of right now, I mean, it's bullish across the board. Like, you look at a lot of these oscillators here. Now, here's the other factor that we're having. So here's the bullish move that we're getting right now. And you can see some of these other bullish moves and how big these candles got right at the very beginning. I mean, look how big that candle was that started that rally. Look at how big this candle was that started that rally. Look how big this candle was. So if you can see across my cursor, and here's the one that failed, right? The one that I pointed out that failed. Excuse me. But if you follow my cursor along, there's the 1, 2, 3 intermediate rallies. There's the last one that was weak, and this one's even weaker as of right now. I mean, this is a very, very weak start to a bullish trend. Again, opens up the probabilities of failure. That makes it a lot higher. But at least it's bullish. It's not closing above the high, which is also what you like to see, right? You like to close above the high point to really reverse this thing. Close above the high point, really reverse that. When you get these signals, right? You close above the high point there. You close above the high point there. See how we close above the high point there? We close. This is a Hakinashi close, no less. Over here, you can see how we close above the high point on these transition candles, right? You're closing above the high point. I mean, when you get the green lines, and that's what we're getting right now, we're not closing above the high point. Again, unless we really take off here at the end of the week, which we very well could. We got 2 days. If we take off in the next Thursday and Friday and really confirm that bear tag, and we do probably close above that high point with the green arrow, and we're going to feel really good about life. And maybe at that time the candle will be bigger than that. But as of right now, that's a really pitiful size, bullish candle that coming off of the transition that should be starting this bullish trend. And so far, right, as of right now, so far, that's a really pitiful start. If you take a look at the 3 green arrows, you can see we're back to 3 green arrows on the NASDAQ, or we still have it. We have 3 green arrows on the Dow and the S&P. There's the bear tags. Nowhere near, you still got 2 green arrows. So we have 3 green arrows across the board, across these 3 major large cap indexes, nowhere close to one on the small cap index. We've talked about how the beginning of 2022, the end of 2021 was a big disparity between the large cap indexes, especially the NASDAQ and the Russell. We're seeing it play out again this go around. So if you look at now the 2 line versions of these charts, you look at S&P and you're like, dang, not only are we getting above the 30-day moving average, we're also close above the 50. I mean, that's and the point of control on the 1-year chart, and you can see again this Fibonacci level. I mean, breaking above 400 would clear these 2 Fibonacci levels and be great. Now, we're not above that high point yet, but I mean, you can see how good this would be. Again, you're looking at the Qs and you're like, dang, we are really bullish. You can see all those Fibonacci lines that we need to clear, right? So, or zoom out again, these lines right here. We haven't cleared above that high point of that big down day either. But you can see again, we're above the 8-day. The 8 and 17 are above the 30. They're rising. The 30 is still above the 50 and may avoid dropping below it. And the MACD is above its moving average. I mean, how much better can that be? Until you look at the Russell and you're like, okay, well, we do have a rising MACD above its moving average, and stochastic still in bearish territory above its moving average, but you are still below the 17-day moving average, right? And the 8 and 17 are way below the 30, and the 30's already crossed below the 50. So remember, it's done that on the S&P too. The 30 crossed below the 50, and we've made this run back above them now. So, okay, if we can hold this and reverse it, great, but a lot of times when you break the 30 breaks the 50, there's a move that comes up to the 30 at about the same time, and then it usually fails if we stay bearish, and that's the point that we're at here right now. Let's look at the DMI, some of these other oscillators. Hey, we got above 25 finally on the positive indicator. We're not below 20 on the negative, so we have a declining ADX at just extremely low levels. Of course, your QQQ is bullish, above 30, below 20. Rising ADX above 20 now, so you actually should be a light green shading there. I'm not sure why it's not. And then you look at IWM, and you can see again we're still the opposite, right? We're still barely below 30 on the negative, not even yet above 20 yet here, and the ADX is still above 20, so it's got the pink shading. So again, we're not changing the direction here. Look at the RSI and the CCI. We're above 50. We're not above 60 yet. We're above 0. We're not above 150 yet. We need to follow through. We need to push higher in the next day or two. Don't fake out, right? Push up tomorrow, finish strong on Friday, go into a new week next week, coming out of this inflation report, coming into the jobs report, feeling very good about life. If we can really finish this week strong. That's how the S&P, the NASDAQ, is clearly above 0 and has broken above 150, is clearly above 50 and has broken above 60. So the NASDAQ is doing what we want the S&P to do. Remember back here, the Dow Jones was doing what we wanted the S&P to do. Now the NASDAQ's doing what we want the S&P to do. But the problem is the S&P won't do it, and that's the broader measure, right? The Russell 2000 is still in bearish territory. So the Russell's like, hey, what about us? And like, well, we're above 0, but you're not above 100. You're above 40, but you're not in the upper half of the chart. So you still got a long ways to go on the Russell to really change the tenor here. But you are, getting some positive momentum. And I told you before, getting above 60, even getting above 80, there's only been really this one failure when you got up there and you just didn't get up to 100, right? And get the moving average to actually get above. Well, you also have the failure. Let's see, there was another one if I remember right. There was, this one over here that also didn't quite get above. But this one, you can see neither one of these got the moving average to actually get above 50. And as of right now, getting above 80 is a big deal. And if we can really break out, great, right? We're just not quite there yet. Close. I mean, the hull's looking good. Again, we don't have the big candle, but at least it's, because again, you look at like some of these other moves, you look at the move that started here in January and you right here, and you can see that this is a daily chart. Look how big that candle was compared to over to the right where we're at now. And again, we're not starting this bullish trend yet with a strong bullish candle. You can see again, here's the candle that started this bullish run, how big it was. Again, look over to the right compared to the candle we're getting now. Nowhere near it. Look at the candles over here that started this bearish bullish move, and even to over here if you wanted to go to this point. Again, way bigger than what we're getting right now. So we're still not getting, even on the, much less on the weekly, not even on the daily chart, but at least we're green, at least we're above the hull. I mean, we're trying to get above the 200. The MACD is above its moving average. Got some strong momentum. Parabolic SARs are way down, so at least, at the very least, we're in the right direction. The breadth looks good. We got above 35. We might be forming a low point. I mean, getting above 35 is a good level. We can stay above here. If we get above 35, it's easier to stay above. The highs and lows index had gotten above its moving average. The skew, unfortunately, is broken back below its moving average. That's not, again, another sign that maybe we're not getting what we want. We're not quite above zero yet. Again, you like to be above zero. You like to be getting more new highs and lows, and we're getting more new lows still than new highs. But at least we're above the moving average. So, man, we're so close. We just can't get over the hump. It's, I was kind of watching a basketball game last night, and the NIT, and the team that I was rooting for was always coming back and would get it close and would tie it up, and even took a lead by one point, but couldn't get over the hump. Eventually lost in overtime. They couldn't get the lead. They couldn't get over the hump. And that appears to be the market. Like, we're trying so hard to be bullish, and it just can't. Sometimes it takes a lead and fakes us out, but then loses it, right? And this is the time that we need it to take it, right? Get it, take the lead into the end of the quarter, right? Into literally the end of the quarter, the first quarter, and then take off from the beginning, with that momentum into the next quarter. If you look at the money flow index here, you can see we're still not, again, where we want to be yet here either. You can see this is where when we first cross this green line and then we come back up now above it, here's where we were, and we're above that level easily on price. We're still not above the money flow level, which means the volume's not supporting the rally. And the money flow itself, back when we broke that green line, it had broken below 50. We're still not above 50 on the index. We're still in bearish territory on the money flow index down here. So we're not getting the volume to support the rally, and we're not getting the breadth yet, as we see, to support that rally either. Good, again, close, but not quite there. Let's look at today's range, intraday range here. And you can see we did gap up. And the question is whether or not this is a runaway gap. Technically, you would like to run away from the open, right? You like, the psychology of a runaway gap is you get a lot of bullish sentiment in the pre-market where there's not a lot of volume, but then once the volume kicks in, then the regular volume traders just build on that momentum in the regular session and keeps going. We don't ever fill it in. Well, we actually did fill in a little bit, not much. We didn't get above below that high point from Monday's high point, but it did fill in a little bit. And we did ultimately close, higher high, higher low, and close at the high. And we closed near the high of the post-FOMC result here, that knee-jerk move. So look how close we are to getting a new, the 4-week high's over here, but by the end of the week, going into next week, that 4-week high is going to be there. And look how close we are. So we're that close to getting the green line spiking to 100. Right, at the very least, it's going to spike to wherever this ends up being within a few days if we don't get above this high point, or wherever the high point may be. We're that close to the green line spiking to 100, with the red line already well below 70. In fact, it's going to be below 30 by the end of the week if we don't get a new high or low, which is most likely. The problem is that a common gap, right? Which usually, when we started out with above 1 standard deviation on the gap. Perfect. That's how you like runaway gaps to start. But then you would like them to keep going and then eventually finish above the 2% mark, because usually the bullish runs start with the 2% gains. We didn't get that, right? Not only are we not getting big candles and everything else I told you, and the near-term line going further momentum, all the other signs that show that we're just not maybe as bullish as we think we are. Here's another one, right? We didn't get a 2% close. After a strong 1% rally, it should have been relatively easy to close 2% higher today, and it didn't. In fact, it wasn't until the very end of the day that we finally got pulled away from the 0.09% mark and finished just almost at 1.5%. So again, in another sign that's like, dadgummit, like why can't we just be bullish? Why can't we just get going with some positive momentum and start kicking some butt here? And every time we do, it's always a fake out, and we've seen how many in the past year, and we've seen the signs. So it's not like we've been faked out, right? I've been telling you, my tag has been bearish for who knows how many months now on the Market Outlook tweets and emails and everything I put out there, where I kind of give you my thoughts just with a simple emoji. It's still bearish, right? I'm still not buying it for all the reasons I'm sharing with you here today. The VIX is dropping like a rock. I mean, the VIX dropped. It didn't continue lower, but at the open dropped all the way to 19, and we're below 90%. We're not below. I mean, again, other times that we've broken below 20, we've been well below this 90% mark. We've been below 85. Like this time when we broke below, both of these times when we broke below 20, we broke below 85%. This time, even over here, we broke below 80% on that decline that finished way up high. Here, I mean, some of these levels, I mean, this one we broke below 20 and we were still above 90. So at least we're lower there, but we're really down. The VIX is down. The VVIX is really down. At a parabolic drop, it's making you wonder a little bit about potential for a V bottom forming on these really volatile instruments. See, normally when the VIX rallies, here, let me zoom out on this. Well, I can zoom out on this one here. Normally we notice when the VIX rallies, it spikes up and then it grinds lower, right? It takes a lot longer to get back to these levels than it does to get there in the first place. And you can see a few examples of that, especially in this past bear market where you jump up, and you can see when it does drop sharply, it tends to rebound pretty quickly. And this was at the beginning of the year. There was that failure over here that led to a big run to the upside, and there's another one right there in June that spiked up. And again, when we spike up, it generally kind of spends more time going down to the downside. You can see that here in the rate of change. For an example, here, let's go, VIX, and then let's look at like the rate of change over like the a small time frame. Let's go like 10 days. So again, you can see how we spike up and then it just grinds. It takes a lot longer. It spends more time below zero than it does above. Spikes up and then it just grinds down below zero this entire time. So unless it spikes down, like when it spikes down sharply, it tends to rebound sharply, and that's kind of what the fear is for the market. Like if we do rebound, like we fill in this gap and we rebound just as sharply as we fell down, then we can jump right back up into where we were in the mid-20s, if not eventually obviously higher, if we actually do turn relatively bearish. So that's the issue right now for that you have a little concern with, and especially considering how bullish we've been with the near-term line rising, everything like that, but very small ranges, very low volume. Look at these last 3 days, very below average volume levels, very, very small ranges. The range here on, you have to include the gap. So we closed at 395.75, the low, well, I guess it filled in that gap. So you had a the range is 6.46. And if you take a look at it on this basis here, the range is 3.436. The average is 6. So, and 1% is 3.9. So we're below 1% there. The range there 2.8, no gap to fill in. So way below 1% there. And then now we have a 2.92 range, but you have to include the gap. So we closed at 395.60. The low at 398.60, so we had about 3 points there to add on. So you're looking at 5.92. It's above 1%, but still below the average. So down into 5.92 is down here. I mean, that's a low range compared to what we've seen for the bulk of this past year, right? 5.92 is right there. So on the lower end of things. And you saw the volume below average as well. So it's not generally bullish. Like, again, just like we talked about, you like to start bullish trends with a move to the upside. Well, we didn't show you the Bollinger Bands. You like to start the bullish trends breaking above 100%. You like to start this with volume, with thrust, with big candles. That's how you like to start them. It doesn't have to stay that way, but you have to have enough bullish momentum to kind of have escape velocity, so to speak, out of this sideways trend we've been on and trend higher. And like I said, it doesn't have to stay there. It just has to start that way. And we're just not getting that start. We're not getting that escape velocity, so to speak, right now. All right, now let's transition into what's driving this market. You can see, again, 3-month chart here. The Qs are just killing everybody. Killing at the highs, 3-month highs for the Qs. Gold near its 3 months highs. The dollar down, but not at its 3-month lows. Commodities down too. But let's look at just today alone. This kind of quote-unquote risk on day. So let's come out here to like a 5-minute chart, and you can see real estate in the Qs, boom, rocket ship to the upside, almost 2%, 2.25% of being Q, and then you can see gold, commodities. The dollar was up, gold, bonds, and commodities all down. So it's kind of a risk on day. IWM eventually lagged but came up, and EFA was there. Emerging markets really struggled. Strength in the dollar put some pressure, I guess, on the dollar there. But you can kind of see things are starting to look a little bit better for some of these asset classes. The dollar, which is really important, when it's been bullish, it hasn't been that good for the markets, but it's been bearish for so long, and it's really been flat for so long after going up and then back down. Still kind of in bearish mode and bearish correction mode. With the it's already in correction mode, and bonds haven't even started their rally yet, right? Usually bonds follow the currency higher, and they haven't even started to move up in that direction. You can see a little bit of an upward day today, but so below the 17-day moving average. MACD is down there, so one day it wasn't even that up. It's actually down. Off of its lows, off of the open, it was up, but still below the 17-day moving average. Again, from a risk appetite standpoint, Bitcoin still holding up very well. A good day near the highs. So you can kind of, again, above these moving averages, above the value area on the 1-year chart. So you can see that the risk appetite is there and trying to get going. Commodity prices breaking down from that 30-day moving average from the value area. And again, just a reminder, as good as that would be from an inflationary standpoint, commodities in correction mode are not bullish, right? That's, it's economic growth is fueled by commodities, consumption, and the less demand there is for commodities, that reflects a, not a growing economy. So that's an issue. Commodities have really been down this whole entire quarter. But it's been below the 17-week moving average all for about 1 week, below the 8-week moving average most of that time. The 8 and 17 are both below the 30. The 30's already crossed below the 50. They're all dropping, even if we're kind of flat on the momentum and stochastics appears to be trying to base. We're still in correction mode. So we're failing at the 30-day moving average and that resistance, and we just don't need to fail here. I know it won't be good from an inflationary standpoint, but I think you have a lot of room to rally without it being inflationary, right? To get back up to at least this 25 level. Get above this, get above these highs. Now we're probably worried about inflation again. But, that's a long ways away. And we might, again, remember the Fed's trying to get inflation down. No one's really worried about inflation going back up again. So I think you have some room to go here without disrupting the inflationary expectation standpoint. Looking at the major markets that are out there, the 12 grid for the major markets that are out there, and again, the bear tag on the S&P, and you can kind of see similar patterns across the board. Italy, France, Germany, Japan already got it, all showing kind of the same. Korea, China, all showing that same bear tag type pattern. UK, Brazil, Canada kind of sitting at the moving average. India's not quite there yet, kind of mimicking the Russell 2000. But we got dark green shading here, or at least light green shading and yellow lines. So we're looking pretty good from that perspective. This kind of reversal type move is occurring across the board. Looking at the sector grid, for the S&P 500. So again, all large caps, not small caps here. Again, the XLK is at its 3-month highs, not breaking through those highs there yet, but closing at its 3-month closing high. And then you got the bear tag on XLY. You have the dark green shading and the green line on XLC, though it's not really moving. You're still energy, materials, industrials, financial, all still below the moving average. Same with real estate. That's one of the reasons why it was so bullish. Dark green shading and the green line for staples. Bear tag on utilities, and close to a bear tag on healthcare. So we're kind of showing that same pattern here. And again, if we can really break through, we kind of need to pull these sectors up with it to really break through. Because when markets start bullish trends, everything goes up. We don't rotate into the beginning of bullish trends. When we're bearish, everything's dropping. When we start to be bullish, when we're coming off lows, everything is rallying. So everything will be dark green shading in the green line to some degree. And then eventually, as you get mature in a bullish trend, then you start to rotate. And that's how the bullish trend continues until it fades, right? Until it loses momentum. And so right now, we're still in the phase where most everything is moving together. You just need to get these last little cyclical areas here to move up with technology and including discretionary. And we need to push. We need to push through these next couple of days, which might be enough to get like XLI, XLB, and XLE above their moving average. Might not be enough for financials yet. They've been hit the hardest. But between real estate and financial and healthcare, or financials, healthcare, and these other cyclical areas, we might have a good Thursday and Friday to get through there. Otherwise, if we fail, then we're back to these lows coming off of a much lower high point across the board. You'd expect we'd go to lower lows, and that's not going to be good at all. Because again, the idea is, the bear market starts when you break that 200-week moving average. Because breaking the 200-week moving average means that you're now transitioning from a bull market correction to a bear market, right? And right now we're still in bull market correction mode. We're above the 8-week moving average. The MACD is turning higher. Like, this is good. I mean, the NASDAQ's doing that. That looks good. That's what we want to see here. But the Russell 2000, on the other hand, is below the 200-week moving average, and that's not what we want to see. Right, the 8 and 17, 8 below the 17 with falling momentum, and the 8 and 17 crossing below the 30, and that's we're below the 200 and well below the 200. So we're not quite there yet. And the Dow is kind of stuck in the middle. It's been very similar to the Russell lately in its weakness. And you can see it's still below its 8-week moving average too, even though its MACD histogram is increasing. So we need to follow through with this. We need to break above the 7. That strength the next couple of days needs to get us through that 17-week moving average on the Dow, get us at least closer to it on the Russell, and then solidify the break up above on the S&P. And then we can solidify this as just a correction. Remember, corrections recover back to, that's the definition of corrections, that you get back to old highs within months. Now it's been 15 months, which is why I think that we're in a bear market, which means we ultimately break the 200-week moving average. But if we're going to finally get a correction bounce, then we will be back up to new highs within months. By the end of the year, easy. We should be back up to new highs by the end of the month. So let's really kind of start that with a couple good strong days tomorrow. If we fill in this gap tomorrow or Friday, then this common gap, and we can't follow through on this, then again, fake out like we've seen. And that's, again, with all the signs I've shown, that's probably more the expectation, at least in my book, it's more the expectation that it is that we finally are breaking out here. All right, now let's take a look at our trade idea of the day, and I want to take a look at Shopify. So Shopify also got that bear tag, but this bear tag, it closed 7% above its moving average. This is its third bear tag, but a much more bullish move than what we saw the prior two attempts to get above there. And you can see, the we're well above the moving average, momentum line much higher level, and now you'd expect now the near-term line to follow the momentum line up. It doesn't have to, but it's better for the near-term line to get there when the momentum line has preceded it. Intermediate lines down or up again, so you got a pretty good chance at a reversal here on the stock. When you look at the 3 green arrows, obviously you did get 3 green arrows today on the stochastics this time though, not the moving average. So you can see the change in trend there. When you look at the two-line version of the moving average, averages, you can see the 8 and 17 day have already crossed above the 30. So and the 30 hasn't even turned up yet, and still can cross above the 50. So there's some good opportunity. We're above the value area, we're above the point of control, above the 200-day moving average. It's now rising. So there's opportunity for us, if we're going to be bullish, for this one that already is bullish, to make its way higher. Look at his weekly chart. You can see it's, again, like the S&P, it's not very bullish. So again, we'd like to see it a little bit stronger, and whether it ends up the rest of this week getting there or not, we'll see. That's the one kind of downside we have right now on the stock, because all the other oscillators are starting to look a lot better, right? The DMI is looking positive, above 25, below 20. Really low ADX that can start to rise. Your RSI and your CCI are getting closer to bullish levels, right? Above 0, already broke above 150. It looks like it's going to try to break above 60 there. Looking at the Ichimoku cloud, you are still in the cloud. It's a very tight cloud, but you got a positive rate of change now. You're above both these lines. You look like you're going to start at least a week bullish trend going. And then finally, your Bollinger Bands and your Keltner channels, the bandwidth is so low, near its 150-day lows, as well as pretty much the 52-week lows, and getting up into, not breaking above the upper band yet, but easily into the upper quartile. And the bandwidth is so small compared to the Keltner channels. Like we're ready for a bust out, one way or the other. And right now, you'd put the odds are that'd be to the upside. So what we decided to do here is say, okay, well, let's look at the stock and let's do a bull call spread, and not as conservative, but not as aggressive either. So we'll kind of go in the middle. So we'll buy the 40 delta, 50, sell the 27 delta. So sell the 55 by the 50. This is what it looks like. Position sizing for a half a normal position, which is what we typically do for directional trades, and getting about a 3-to-1 reward, which is, for considering where the max gain is relative to the 1 standard deviation move, which is pretty close. Doesn't give us a lot of forgiveness. It's kind of, we'd prefer to move like right now and not push this any further out of that range. Generally, you're looking at maybe a 4 or 5-to-1 reward to risk ratio at that point. Now that we're at less than 3-to-1, it kind of shows that the options market feels like this is a little bit higher probability. As you can see from the chart, like things are looking a lot better for an upside move, that we can kind of follow through on this. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon down there. Comment on the video. Subscribe to us at marketscholars.com for free. Like us and follow us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.